You're staring at your paycheck. You see the taxes taken out, the health insurance premiums, and finally, you wonder how much you should be setting aside for your future self. Maybe you have $200, maybe $500. But then the acronyms hit: 401k, Roth IRA, traditional IRA. It feels like a guessing game where the wrong move costs you thousands in taxes later. By the end of this video, you'll know exactly how to prioritize your accounts to maximize every single dollar you save. The reason most people stay stuck isn't because they're bad with money, it's because the system is designed to be overwhelming. You want to save, but you're paralyzed by the what if. What if you lock your money away and need it for an emergency? What if taxes go up and you're in a higher bracket later? Many beginners end up doing nothing, keeping their money in a low-interest savings account. Meanwhile, inflation is eating away at your purchasing power. If you don't pick a strategy, you're essentially paying the IRS a tip every time you retire. We're going to stop that today. You don't need a finance degree to build wealth, you just need a clear, repeatable order of operations that removes the emotion from the decision-making process. Step 1 is the golden rule of retirement: never leave free money on the table. If your employer offers a 401k match, that is your absolute first priority. Let's say you earn $50,000 and your employer matches 100% of your contributions up to 3%. That's $1,500 of essentially free salary you are missing out on if you don't contribute. No index fund or high-yield savings account will ever give you an immediate 100% return on your money like a 401k match. Before you open a Roth IRA or pay down extra debt, get the full company match. Use a tool like the Investment Match Calculator on NerdWallet or Bankrate to see exactly what that match adds to your total compensation. It is the highest leverage move you can make in your financial life. Once you have secured that company match, step 2 is focusing on the Roth IRA. The reason we prioritize this over more 401k contributions is flexibility and tax-free growth. With a Roth IRA, you pay taxes on your money now, but it grows tax-free, and you can withdraw it tax-free in retirement. Even better, you can withdraw your own contributions, the money you put in, not the earnings, penalty-free if you absolutely need to. This acts as a safety net that a traditional 401k doesn't offer. You can open a Roth IRA through major brokerages like Vanguard, Fidelity, or Charles Schwab. Use their retirement planner tools to see how your money could compound over 20 or 30 years. It's about building a tax-free bucket of wealth that the government can't touch later. Step 3 is looking back at the 401k. If you have hit your Roth IRA annual limit, which is $7,000 for 2024 if you are under 50, and you still have extra cash to invest, go back to your 401k. The reason we prioritize the Roth first is because 401k plans often have limited investment choices and higher fees. However, once your Roth is capped, the 401k becomes a powerhouse for lowering your taxable income today. Contributing to a traditional 401k lowers your AGI, or adjusted gross income. This is particularly useful if you are in a higher tax bracket and want to save on your current tax bill. Use a tax savings calculator to see how much your contribution is actually saving you on your annual income tax filing. Step 4 is the final tier: automation and rebalancing. Once you have set these accounts up, don't let them sit idle. Choose a target date fund or a low-cost S&P 500 index fund within these accounts to ensure you aren't paying unnecessary fees to active fund managers. If you find yourself having extra money after maxing both, look into a health savings account, or HSA, if you have a high-deductible health plan. It's the ultimate triple tax-advantaged account. The key is to automate your contributions so the money leaves your paycheck before you ever see it in your checking account. When the decision is made for you, you won't be tempted to spend that money on things that won't help your future self. To track your progress and make sure you aren't paying unnecessary fees, I highly recommend using a consolidated dashboard. Personal Capital, now Empower, is excellent for seeing your entire net worth, including those 401k and Roth IRA balances, in one place. You can link your accounts to track your investment performance and retirement readiness for free. If you're looking to open a new brokerage account to start your Roth IRA, Fidelity offers some of the lowest cost index funds in the industry. Check out the links in the description below to get started with these tools today. They are free, they provide clarity, and they help you stay on track with your long-term goals. To recap, get your 401k match first, max out your Roth IRA second, and return to your 401k if you have more to save. It's simple, it's effective, and it works. If you want to dive deeper into how to pick the right index funds inside these accounts, watch my video on how to build an investment portfolio next. Don't forget to hit the subscribe button for more straightforward money moves. Your future self will thank you for starting today.